Hello, hello. Good morning to everyone. I see you're all coming into the room, so welcome. I'd like to, of course, welcome you to today's Center State CEO webinar, Understanding Eligibility Changes to the Employee Retention Credit. So glad that you were able to join us today. We appreciate your participation. My name is Jessica Underwood, and I am the sales manager here at Center State CEO. I work in membership. So if any of you are interested in learning more about membership and those great benefits, I am your gal. I can help you with that. And I'll also be your moderator for today's webinar. So again, welcome and thank you for joining us. So this webinar today, of course, will cover the changes to the Employee Retention Credit and the questions you may have about these changes. A huge thank you to Dannible McKee for presenting today's webinar. And we are very lucky today to have Nick Shires here with us. I'll give a little bio about Nick before we get started. So he's the partner in charge of tax service at Dannible McKee. He's a certified public accountant with over 16 years of experience providing tax and consulting services to a wide range of clients. Nick specializes in all areas of corporate and individual income tax compliance with a focused expertise in the area of tax credits and incentives. Nick is a local SU graduate, a graduate of the Leadership Greater Syracuse class of 2020, and a member of the 40 under 40 class of 2020. So thank you, Nick. We're so glad to have you. So before I pass it over to you, just some ground rules. I know that we're all pretty used to doing webinars now. It's been a year of webinars, but just so that we all know, everyone will be muted during the entire webinar. We do welcome your questions. Nick will try to answer those questions. We'll kind of do a pause after each slide just to kind of check in and make sure that everyone's on board. Please drop those questions in the chat box though. We will still keep everyone muted. There are a lot of us here today, which we're excited about. We will be recording the webinar and the presentation slides will be available afterwards as well. So I think that covers all of the housekeeping, and now on to the good stuff. Nick, on to you.
Great, thank you, Jess. Happy to be here, and thanks to Center State for allowing us to be here and present some pretty timely information and some important information, I think, for businesses and employers in our community that can take advantage of a pretty prominent tax credit that is made newly available in December with the law that was passed. So as Jess mentioned, feel free to throw the questions into the chat and I'll try to address them timely as we go through. I tried to leave plenty of time in here to make sure that we can address your questions, because there are a lot of scenarios that can come up in regard to eligibility for the credit, and I want to make sure that your concerns are addressed. And if we don't get to all the questions, feel free. My contact information is in the slides, and would be happy to address those afterwards if we need to. So with that, let's get right into it. So employee retention credit. So first step we have to do is kind of take a look back at the history and the timeline of this credit that's available. So the employee retention credit, it was introduced by the CARES Act, Section 2301 of the CARES Act, back in March of 2020. So as the pandemic was really starting, Congress wanted to get money into the hands of employers to make sure that they can keep employees on the payroll, even during periods of maybe a shutdown or periods of decline in business as a result of people having to shelter in place, having to close down businesses. So the CARES Act was one way in which there were a number of provisions in there, and one of them was the employee retention credit. Unfortunately, back in March of last year, because of some of the provisions that were included as part of the employee retention credit, we didn't see this utilized a whole lot. The benefit of it was kind of pushed to the wayside because one key provision. You couldn't utilize this credit if you took a loan under the Paycheck Protection Program, the PPP loans. So it was an either or situation. So you could take the credit, you could take the employee retention credit. We'll talk about how much that credit is and how it's calculated. But you could take the employee retention credit, or you could take the PPP loan. And in most cases, the PPP loan was more beneficial and more lucrative for employers and was a better source of funds to keep people employed than the employee retention credit. So we didn't see a whole lot of use of this credit and a whole lot of benefit from the credit for the 2020 tax year. It started, you could take the credit base for wages starting March 12th. And like I said, we didn't see a whole lot of benefit from it. But that has since changed. Then in April, the IRS released their guidance in how to compute the credit, some scenarios, some guidance, some examples, and in what's called their frequently asked questions, their FAQs. They haven't updated this for the new act that was passed in December yet. So we're still waiting on that guidance. And it's important to note that while these frequently asked questions provide some good guidance and some good groundwork for the calculations and who qualifies for the employee retention credit, these are not authoritative support. So these FAQs cannot be used as your supporting documentation if in the event that the employee retention credit that you claimed is challenged. These FAQs are more for guidance and a good source of reference as you compute the credits. Then in December of 2020, right at the tail end of December, we had an extension and an enhancement of the employee retention credit. So what that did is it did two things. It opened up the availability and expanded the availability of the 2020 credit retroactively. So we can go back and take a look at your eligibility for the 2020 credit based on wages paid from March 12th through December 31st of 2020. The big thing there is it allowed for some more flexibility. If you took a PPP loan and paid wages with PPP funds during 2020, you could still be eligible for the employee retention credit. So it's no longer mutually exclusive. You can benefit from both the employee retention credit and the PPP loan funds that were eventually forgiven or to be forgiven. So we'll take a look at what we can do for the 2020 wages that were paid and how you can qualify and how that interplay between the employee retention credit and the PPP funds works. The other thing the act in December did is it extended the availability of the employee retention credit and increased the amount of the credit that's available for the first 2 quarters of 2021. So eligible employers can now not only go back to 2020 and claim the credit, it's also on a prospective basis looking at the first 2 quarters of 2021. So a nice benefit there. And we'll take a look at how that works out. So the first real question is, how much is the credit? What's the benefit of claiming the credit, doing the work, going back through, retroactively claiming the 2020 credit, looking forward for 2021, the first 2 quarters? How much is the credit? So for 2020, we have to look at these on a separate basis because the credit calculations and the eligibility tests are different for the 2020 credit as they are for the 2021 credit. So we have to look at both years on a different basis. So for the 2020 credit, 50% of what's called qualified wages is the amount of the credit. So qualified wages maximize out at $10,000 per employee. So really the credit amount for 2020 would be a maximum of $5,000 per employee, and that's for all quarters of 2020. So for the whole year 2020, you could get $5,000 per employee. Now it still can be a fairly significant credit. we ran some scenarios for a client with about 80 employees during 2020, and the amount of the credit that potentially eligible was up to about 350,000. So some pretty substantial credit for 2020 that we can go back and take now. So there's some benefit out there, and there's some real opportunity to maximize that benefit. Then we look at 2021, and I mentioned they extended the credit, but they also enhanced the credit. So for 2021, the credit amount is 70% of qualified wages. Same maximum amount per employee of $10,000. So $7,000 per employee is the maximum amount of the credit. However, that is on a per quarter basis rather than on an annual basis. So you've got $7,000 per employee per quarter that's allowed as a credit. So that could be up to $14,000 for the first 6 months of 2020, up to a $14,000 per employee credit. So almost 3 times the amount of the benefit that you could have received for 2020 when you think about 5,000 versus the 14,000. So that same employer that realized a credit of 350,000, that same wages for the first 2 quarters of 2021 could be up to about $1 million worth of credit. So really a substantial benefit that could be realized.
So it looks like just going to pop in for a second. So we've got one question here. So the
Sure.
ERC goes to June 30th.
So it's the first 2 quarters of 2021. So we'll see that later on. I've got a couple slides on the new stimulus bill that was presented to the House and should be voted on tomorrow by the House. There is a proposal to extend the eligibility and availability of the employee retention credit, but that does go through it for wages in the first 2 quarters of 2021.
Thank you.
Yep. Okay. So the next thing we have to look at, so we've got the amount of the credit. Now we have to look at who is eligible for the credit. So who is an eligible employer? So an eligible employer has to experience at least one of these 2 scenarios to be eligible. And what these scenarios do is they provide basically a time frame for when your wages are eligible or qualified wages. So we're identifying a time frame where you are an eligible employer. And one of those scenarios is you have to experience a full or partial suspension of operation and due to a government order. So a government shutdown of some sort has an impact on your business in a full or partial suspension of that business. And the other way in which you become an eligible employer is you experience a period of significant decline in gross receipts. We'll see the definition of that changed. For 2020, that definition was a 50% reduction in any calendar quarter compared to 2019, that same calendar quarter. So a 50% reduction in top line revenue during that quarter, any quarter, that quarter would qualify as a period of significant decline in gross receipts. The definition really fairly similar in 2021. However, that period of significant decline, that revenue reduction is reduced to 20%. And we'll see there's kind of some intricacies into how that reduction works and how the quarters, the eligibility in certain quarters works, and we'll walk through kind of how that shakes out. But first we have to look and see if you have a full or partial suspension of operation due to government order. Looks like we've got a couple more questions popping up into the chat there.
Yep, it looks like we've got a question here. Do you compare both 2020 and 2021 to 2019 gross revenue?
Yep. So we will get to that, but yes, so when you're comparing the test, the gross revenue test for 2021, you do compare it back to 2019 rather than 2020, unless you were not in operation during 2019, and then you would compare your 2021 gross receipts and gross revenues to your 2020 gross revenues.
Okay, I'm going to skip ahead. We got another question here. How are
Okay.
gross receipts defined? Cash receipts or revenue?
So gross receipts are defined based on your tax basis method of accounting. So if your cash basis method of accounting for tax purposes, then your revenues for this purpose would be done under the cash method. If you are accrual method taxpayer, then your revenues would be determined on a accrual basis. So it looks to your tax method. So there may be some calculations you have to do. Your internal reporting, your GAAP financial statements are not necessarily done on the tax basis. So you may have to do on a quarterly basis a financial statement to tax basis reconciliation. So there may be some calculations that need to be done. It's also important to note that gross revenue and gross receipts is not just your operating revenue. It also includes other sources of revenue, interest, dividends, capital gains, basically any source of income other than PPP funds or this ERC credit would not be considered income for purposes of determining if you have a decline in gross receipts.
Okay, and I'll go back. So how many months of suspension is considered a partial suspension?
So a partial suspension isn't based on the number of months. It's a time frame that you've experienced a partial suspension. So we'll kind of walk through how that works. But a partial suspension, it opens up your time frame for being an eligible employer. So if you were partially shut down for 2 weeks, you're an eligible employer for 2 weeks. So that's kind of how that works. And if wages paid during that 2-week period of partial suspension or full suspension of business would be your wages that are eligible for the employee retention credit.
Okay.
You good to move on here?
May have answered part of that next question. So what is a nominal partial shutdown and what percentage of total business revenue is considered nominal?
Yeah, we will get into some of the definitions here on full or partial suspension. I did mention before we hopped on here that this would be a source of some questions because of the nature of how gray some of the language and some of the lack of specific guidance we have in this area. So let's kind of walk through what guidance we do have, and then maybe we can address some of those questions after we go through that.
Sounds good.
So a full or partial suspension of business, in some cases, very easy to define and identify. It does have to be the result of a government order, proclamation, or decree, and this has to be some form of written order. You know, if the governor comes out in one of his press conferences and recommends that people shelter in place for 2 weeks, that's not a government order. A government order has to be something that's written and is decreed and has to be in place, and not necessarily just a suggestion or something that's stated in a press conference. So important distinction there. So some of the easy scenarios, if you were a non-essential business that was forced to close, you had to close down and could not operate. This is more in the springtime of last year, as this was first happening. If you have a forced closure or forced partial shutdown, places like restaurants that are still experiencing a limited capacity due to a government order, some of those types of things, those would be, pretty clear cut that you had a suspension of business if you were directly shut down based on a government order. Shelter-in-place orders can be a reason for partial or full shutdown if your employees can't come to work because they're forced to stay at home and you're a non-essential business and your employees can't come to work, then potentially you have a full or partial shutdown. If curfews that are issued by the government, then those impact your hours of operation. If you're a manufacturer that has a 24-hour manufacturing facility, and your employees that normally are working overnight have to be at home at 10 o'clock and that sort of thing, then you would have a full or partial shutdown. You would have a partial shutdown because you could not continue with your normal operations and your normal hours of operations. And if you have mandatory closure as a result of having to clean and disinfect, same thing, similar sort of thing. If you're a 24-hour operation, but you have to, at the end of each day, close down and for a period of cleaning, your 24 hours now becomes, 18 hours, and you've been affected and you have a partial shutdown. So it's pretty easy if you're directly affected and you're directly shut down, your employees. However, if you're an essential business that was allowed to continue to operate, there are some scenarios where you may have experienced a partial shutdown or a partial suspension of your business. And I think one of the questions was, what is a nominal portion of business being suspended? I don't know. Because the IRS didn't tell us what that is. So they've used in their FAQs, they've used one of their favorite terms called facts and circumstances. So you have to look at the facts and circumstances in each specific case and make the case that you've experienced a nominal portion, a nominal shutdown, a nominal suspension. So the word nominal does not have a true definition because they didn't define it in their FAQs. They just simply said that it's based on the facts and circumstances, and if you can prove that it's more than nominal, then you have a partial shutdown. And so they did give some examples of, what would create a partial suspension for an essential business. The one I think that would be the most common is a supply chain interruption. So you may be an essential business. You might be a manufacturer that's manufacturing essential items. However, if your suppliers are not essential and you can't get the raw materials that you need to make those essential materials, you have a partial suspension of business because you cannot continue to operate and manufacture the items that you did before because of a partial suspension related to a supply chain interruption. And that supply chain interruption has to be, all of these still have to be as a result of a government order. So if your supplier is shut down because of a government order, then you may meet this test. A couple scenarios where they specifically identified were not a partial suspension. So one was if your customers are required to stay home, there's a shelter-in-place order where you can't reach your customers, you can't get your customers can't come into your facility. That does not give you a partial suspension of your essential business. Basically, the IRS is saying you have to be able to adapt and get your product or your service to the clients in a different way. And another one where it was not a partial suspension is if you have an office closure, but you're an essential business and you're still able to continue operations through telework and through remote operations, then that also wouldn't be a partial suspension of business. So you think the example they used was a software developer where they took all of their people, put them with computers at home. They were able to continue and operate and work from home on a remote basis at 100%. So they did not have a partial suspension of business, even though their office was closed and they couldn't have people coming into the office. So I mentioned a couple of the other scenarios, a reduction of operating hours, that would be a partial suspension. If you have multiple locations, so if you have multiple locations and because of a local order, one of your locations was suspended, then it's deemed that you have a partial suspension of all of your locations. So kind of an interesting interpretation there, but that the IRS had, is that if you have one location that's out and not able to work at its full capacity, then it's deemed that all of your locations have incurred a partial suspension of your essential business. And similar, if you have multiple companies operating in different areas and different industries that are part of an aggregated group under the same ownership, if one experienced a partial suspension or a full suspension of business, then the whole aggregated group has now experienced at least a partial suspension of business and would be an eligible employer. So as expected, I think this slide prompted a few questions.
Absolutely. Hi, it's Jessica. So I'll go back. So I've got one. Can we use full or partial shutdown for some quarters in 2020 and then use decline in revenue for other quarters?
Absolutely. So these are, you can have both. You can have one or the other, and you can, or you could have neither during a certain quarter. So as I mentioned, the suspension of business is only makes you an eligible employer during that time of suspension, full or partial suspension. As we'll see with the decline in gross revenues, that would qualify you for the full quarter. And we'll talk about how that works, but you could have both. So if you had a partial suspension from the 1st of March to the end of March, you'd be an eligible employer for the month of March. Then you get to the second quarter. If you have a significant decline in gross receipts in the second quarter, you would be an eligible employer for the full second quarter. So you've got a suspension for a month and a significant decline in gross receipts for the full quarter. You would now be qualified. Your wages paid from March 1st through the end of the second quarter through June 30th would all be eligible wages, qualified wages.
And so for restaurants that have restaurants have been in either a full or partial shutdown since the beginning of the pandemic, so the wages during this entire period would be eligible?
That's correct. You would be determined to be an eligible employer during that time of partial or full suspension of business. And in most cases, a restaurant that's been significantly impacted would be able to meet the significant decline in revenue test. It's a lot easier to substantiate and defend a calculated test based on revenues and show substantiated support for that than it is to meet the definition, the gray definition of a nominal portion of your business being suspended. So if you can use hard numbers and calculated numbers, us accountants like that a lot better than trying to define nominal in the terms of the definition. So if you can meet the significant decline in gross receipts test, that's the easier way to defend that you're an eligible employer and to substantiate that you're an eligible employer. However, you can meet it under both tests.
And next question, do you include received COVID funds from CARES Act, U.S. Health and Human Services, and Medicare advanced payment in gross receipts for comparison of 2020 versus 2019? Yeah,
so the only thing that's excluded from the definition of gross revenues would be forgiven PPP funds and EIDL, economic injury disaster loans, are the only things that are excluded from the definition of gross revenue.
Okay. And then last question in this batch. We are an automotive dealership and our entire sales department was deemed non-essential. Therefore, only half of our business was able to operate. Do we have to separate wages by department or use the entire business wages?
No. So if you have a partial suspension of a essential business and it's more than a nominal portion, so if your entire sales team, I would think that's more than a nominal amount of your business. If you're not allowed to sell cars as an auto dealership, then I think you've got a more than nominal suspension of part of your business. You are an eligible employer for that period and all wages paid. We'll get to which wages qualify. It depends on the size of the employer and how many employees you have. But we'll kind of talk about how that calculation works, but you are deemed to be an eligible employer during that whole time of partial suspension.
And we just had one more pop in if we have a little time to do this. So
Sure.
If we are an essential business and had no shutdown, but our gross revenue is down more than 20%, are we still eligible for the ERC?
So for 2020, it has to be a 50% reduction. And actually, that's a good question to lead into the next slide. So we'll get right into it.
Perfect.
So if you were an essential business, you didn't have a partial or complete shutdown of the business, then you would look to the significant decline in gross receipts test to make you an eligible employer. So the definition is different for 2020 as it is for 2021 for the employee retention credit. So for 2020, the period of significant decline starts when you have a calendar quarter. So for the whole calendar quarter, your revenue is 50% or more lower than it was in the same calendar quarter of 2019. So if you have a 50% revenue reduction in the second quarter of 2020, then you would be an eligible employer for starting the beginning of that quarter. So April 1st would be, you'd be an eligible employer. You're an eligible employer for that whole quarter. And then your period of significant decline for 2020 ends when you have a calendar quarter in which that revenue decline goes below 20%. So the way that works is the first quarter in which you have a 50% revenue reduction. So in my example, the second quarter, you're qualified starting in the second quarter. So April 1st is your beginning date. You have at least 2 quarters where you'll be a qualified employer. And you'll have a period of significant decline because the next quarter, the third quarter, if your revenue reduction in the third quarter is less than 20%, you'd be eligible for the second quarter and for the third quarter. And I've run across a scenario where we had a greater than 50% reduction in the second quarter, a 30% reduction in the third quarter, and then in the fourth quarter, the revenues were similar to what they were in 2019. So in that case, it's a qualified employer for the second quarter, the third quarter, and the fourth quarter. So your wages paid from April 1st through December 31st of that year would all qualify. I hope that answers the question that came in on the last slide. Then in 2021, the definition of a declining gross receipts changed from 50%. So the calendar quarter changed from 50% to a 20% revenue reduction. And as I mentioned before, you take 2021 and compare it to 2019. If you were not in operation in 2019, you could take that calendar quarter of 2021 and compare it to 2020. An important difference here for 2021, you can elect to use the preceding quarter as your baseline test. So for the first quarter of 2021, if you have a 20% revenue reduction in the fourth quarter of 2020, you would automatically qualify regardless of whether you have a reduction in the first quarter of 2021. kind of interesting. So similar that if you have a 20% reduction into the first quarter of 2021, under that test, you would automatically qualify again for the second quarter. So kind of an interesting distinction between the two and what qualifies as a period of significant decline. And that makes, if you meet those tests during those time frames I laid out there, then you're an eligible employer.
So it looks like we had a question pop in for 2020 quarters. Can the first quarter of 2020 be used for the 50% reduction?
It cannot because, well, you could use it, but the wages in the first quarter that would be eligible are starting in March 12th. So if you have a 50% reduction in the first quarter, then you would be an eligible employer during the first quarter, but wages only start beginning March 12th. And then if you have that 50% reduction, then the second quarter would also qualify until you have a revenue reduction of less than 20%.
Okay, and another one just popped up. So if we qualify end of this quarter, then we claim the second quarter?
Correct.
Okay.
And the first quarter. So you can, and we'll talk about how you get the credit. And one of the reasons that preceding quarter test is used is because you can reduce the amount of the payroll tax deposits that you make on a prospective basis. So how would you do that other than already knowing that you qualify? So if you know that you're qualified in the second quarter, you can reduce the payroll deposits that you're making on a prospective basis.
Okay, and we had one more pop in if we've got a second. So do revenues need to be based on calendar quarters? We are an FYE 228 and perform percentage of completion calculations on our corporate quarter ends to adjust revenue.
Yep, unfortunately, no matter what your fiscal year ending date is, the definition is based on a calendar quarter.
Thank you, Nick.
Yep. Okay, so qualified wages. So you've determined that you're an eligible employer during a period of time. Now, what wages to pay during that period of time are qualified wages. So it's different. Qualifying wages are different if you're a large employer or a small employer. So a large employer for the 2020 credit is an employer that has an average of over 100 employees, 100 full-time equivalent employees, and that test is based on 2019. So your employment level during 2019. If it's over 100 employees, then only wages paid as an eligible employer to employees who are not performing services would qualify. So basically, you have to be paying people to stay home and not come to work and not perform any services. So as long as you kept them on the payroll while they weren't working, as a large employer, you would be eligible for the credit during that period where you're an eligible employer. And those employee tests are done on an aggregated basis. So if you have a combined group that's treated as under the IRS definitions as a single employer, you have common control, common ownership amongst multiple companies, that employee baseline test is done on an aggregated basis. So then small employers, so if a large employer is over 100 employees, a small employer would be any employers with 100 or fewer. Then all wages paid during those qualified periods, so during the period of a partial or full shutdown, and during a period where you've got a significant decline in revenues, all wages paid during those periods are qualified employee retention credit wages. And the definition for qualified wages, same in 2021 as it is in 2020, except the definition of a large employer changed, and they increased it from 100 employees up to 500 employees. So the same test, same way of calculating what a large employer is, same way of calculating what wages qualify, but the number of employees is different. And I'll point out that wages include healthcare costs that are applicable to each of the employees. So it's gross wages and healthcare premiums that are paid by the employer. Okay. And then we have to look at, I mentioned that previously you could not utilize this credit if you took a PPP loan. However, you can now, but there is a distinction. You cannot utilize the wages that are forgiven under the PPP program and utilize those same wages for purposes of calculating the employee retention credit. So this is where it gets to be complicated and some calculations have to be done. We don't yet have specific guidance on which wages qualify under which bucket. So the PPP program, if you've already filed for your forgiveness and reported wages, I know many employers utilize, there are multiple different types of costs that can qualify for forgiveness. But the easiest way to get the forgiveness approved and filed is if you use all of the funds for payroll. You can submit your 941s with your PPP application, and you'd get full forgiveness. But your application shows that a large majority of your forgiveness is the result of wages when you could have used other costs to achieve the same result. So the question becomes, can we go back and say, well, I didn't necessarily have all of those wages forgiven. I want to reduce the amount of the wages and payroll that I used under the PPP program to be forgiven, and recalculate that and refigure that, and then utilize those same wages for the employee retention credit. And I think that based on the guidance and based on the language in the law, we may have the option to take a look at doing that and recalculating the amount that would be needed to achieve full forgiveness under the Paycheck Protection Program. But it's important to note, wages cannot be, you'd have to identify and show that wages were not forgiven under the PPP and also used as part of the calculation of the employee retention credit. So it still makes sense to apply, and if you're looking at PPP 2, still makes sense to apply because PPP program offers refundability of 100% of wages and payroll costs, where even under the new program, the 2021 employee retention credit, you're looking at 70%. So if we're looking at the order of things, first you take the Paycheck Protection Program. You also have the Families First Coronavirus Response Act, the FFCRA. That's their paid sick leave credits, mandatory paid family leave credits. Again, that's 100% of wages up to a certain limit, depending on the type of leave they are taking. So that would come in priority line before the employee retention credit. So you take the Paycheck Protection Program loan, you take the FFCRA credit, then I think the employee retention credit comes in third. And then because you get a pretty substantial benefit from the credit like we talked about. And then if you've taken that credit, if you've taken the employee retention credit, those wages can't be included in other income tax incentives that are based on wages. So the significant ones would be the R&D credit, research and development credit. If you've got a wage base that you're using to determine that, wages used for the employee retention credit cannot be included in that. Same with the empowerment zone. Downtown Syracuse is an empowerment zone. So wages as an employer, you pay to employees that also live in the zone, qualify for an income credit. but you wouldn't be able to use the same wages for that as you do for the ERC. And same goes for the work opportunity credit. So basically you can't double dip on the same wages. So you have to take a look and put a spreadsheet together and map it all out to kind of figure out which buckets do certain wages fall into. Looks like maybe that prompted a couple questions.
Yes, indeed. So, hi, it's Jessica. If you are a large ER and reduced your CE's hours from 40 to say 30, can you take the credit on the wages for the 10 hours?
Say that one more time. So they have employees that working 40 hours.
That they reduced the hours from 40 to 30 hours a week. Can you take the credit on the wages for the 10, the difference?
If they're not performing, if you're paying them during a period where they're not performing services and you're an eligible employee during that time, so you still have to meet the eligible employee or test. You have to have a partial shutdown or a significant decline in gross receipts. If you're paying them to stay home, they work 30 hours and you pay them for 10 hours to stay home, then I would say that would qualify as wages paid to not perform services.
Okay. Hopefully that answered that one. And then the next question, so if two brothers are 50% employee owners, can their wages be included for ERC?
Yes, wages for shareholder employees qualify.
Okay. And
up to the $10,000.
So is the ERC based solely on the wages paid by the employer, or does it also include the employee's declared tips?
It's just the wages, and it would be the Medicare wages that's would be reported on their W-2.
And that's it for right now. I think we're up to date. So.
Okay. So the most important part is how do you, now that you've determined you're eligible for the credit, you've determined the amount of the credit, how do you get that money? So for 2020, you're going to have to file an amended Form 941, and that's your quarterly payroll return. If you qualified in multiple quarters during 2020, a streamlined procedure allows you to make that amendment all in the fourth quarter of 2020. So you only have to file one amended return as opposed to filing amended returns for each eligible quarter. So that would be the way you get your 2020 credit back. And if your credit exceeds the amount of tax that you paid during that period, then the excess becomes refundable. So it is a refundable credit. For going forward, so your first quarter of 2021, if you're eligible, if you determine after the fact that you're eligible, you would file and claim the credit on your first quarter Form 941 as an option. As I mentioned earlier, another option is if you already know you qualify, if you qualified based on your fourth quarter 2020 revenue test, the 20% revenue test, then you could reduce the amount that you put on deposit with the IRS in advance. So rather than waiting until you have to file the 941 after the quarter ends, you can reduce your deposits on a go-forward basis. And the last option you have, similar to reducing the payroll tax deposits, if you anticipate that your credit is going to result in a refundable amount, if the credit exceeds the amount that you would have in required tax deposits, then you can request an advance payment of that refund prior to filing the 941. And that's on a new form called number 7200. So multiple options, and different ways of claiming the credit and getting the money in the employer's hands. So that's everything I've got on the ERC. I know it's a lot to take in, and as I mentioned, my contact information is in the slides. I know there's going to be scenarios that are different, and a lot of definitions that can't encompass all of every scenario that's out there. So feel free to reach out, and I'll try to answer any questions that you may have after the fact.
Yeah, I was just about to pop in and say we don't have much time left, so we want to make sure that you finish up. So if there is any time at the end, I'll finish up with questions, or you're welcome to send them right to Nick. So I'll shut up for now.
Thank you, Jess. So I just wanted to go through some of the other benefits from the act that was passed in December. We know the PPP program. So they did clarify the tax treatment of the PPP. So the IRS had come out with some notices back in the summer of 2020. But essentially, long story short, is they made the PPP funds, forgivable funds, taxable and taxable in 2020, which kind of went against the initial intention of the CARES Act. So Congress pushed through and clarified that PPP funds are not taxable. So a nice benefit after us accountants had been delivering bad news all the way through December to all of our clients that was going to be a taxable item. We got that good news at the last minute in December. And the December Act also introduced the second draw loans. So if you had used all of your proceeds from the first draw, you could go in for a second PPP loan if you had 300 or fewer employees and you met a gross revenue reduction test similar to the ERC. You had to show a significant decline in revenue. Same thing, calendar quarters compared to 2019. And if you had it in any quarter of 2020, a reduction, then you could apply for the PPP second draw. Those are applications open until March 31st. I don't know if they're looking to extend that deadline, but March 31st was the deadline in the law as written. And then the calculation of the maximum amount that you could take is the same as it was for the first draw. It's 2.5 times your average monthly payroll. And you could do that based on different periods. So you could do it based on the calendar year 2019 payroll, or you could do it based on the trailing 12 months of payroll, or you could do it based on calendar year 2020 payroll. So it's typically best to use whichever payroll was higher. And in most cases, I'm finding that 2019 payroll was higher. And that 2.5 times, and the maximum amount of the loan was reduced from 10 million down to, for the second draw, it's down to 2 million. For restaurants and hotels, second draw PPP, instead of 2.5 times the average monthly, it'd be 3.5 times. And I mentioned earlier that the additional costs are deemed to be eligible for forgiveness. There's some additional administrative costs and some operating costs that now would be eligible for forgiveness in addition to your payroll costs, mortgage interest, rent, and utilities, which were eligible previously. And the forgiveness on the loans changed a little bit. So your covered period for the loans can be any time in between 8 and 24 weeks, where previously it was either 8 or 24 weeks. Now it can be any time in between. You still got your payroll, rent, mortgage, interest, and utilities, plus your additional costs, which I just mentioned. 60% of the total forgiveness amount has to be used for payroll. So you can't use 100% of the costs, 100% of the PPP costs for those other costs, for your rent and your mortgage and your utilities and your operating costs, at least 60% of the loan proceeds have to be used for PPP or for payroll. And then within this new law introduced a simplified forgiveness form. Basically, you just have to certify that you used all the funds for the appropriate expenses. You don't have to provide all of the additional support if the loan was under $150,000. We've also got your paid sick and family leave credits. These credits were extended through most of March. If you've got people that are out because of a required government quarantine, either they're sick, tested positive themselves, or they came in close contact, your employee is required to quarantine, you have to pay them for basically up to 2 weeks while they're out at a maximum of $510 a day up to $5,110. If they are out because of another reason related to COVID, they have to care for children that are home because school is closed or daycare is closed. The amount that they've got to pay for those is reduced to $200 a day and $2,000 for the 2-week period. And there is the additional, if somebody's under that scenario with school or daycare unavailable, it could be up to a 12-week period. There's an additional 10 weeks that potentially would have to be paid. There is a credit for that, payroll tax credit, up to 100% of that amount that's paid out. I'll quickly go through this. This is the American Rescue Plan. Some of the provisions that are in the House Budget Committee proposed and drafted a bill that is expected to be voted on tomorrow by the House. And this is the one we've been hearing about, the next stimulus bill. So the individual provisions in there would be an economic impact payments of an additional $1,400 per taxpayer, spouse, and dependent. So that's $1,400. Could be for a family of 4 up to 4 times that. So a pretty significant amount. There's also some changes proposed to various credits. The child tax credit would increase from $2,000 per child to $3,000 per child, and up to $3,600 if the child's under 6. The earned income tax credit, they're proposing to expand the availability of that, as well as the child and dependent care credit and the premium tax credit. So a number of credits that are geared towards lower income taxpayers. They're proposing to increase the availability and refundability of some of those credits. And on the business side, employers can provide dependent care assistance that would not be included in the employee's pay. Right now, that is limited to $5,000. That would be increased to $10,500. They're proposing to extend the paid sick and family leave credits and increase the covered wages from $10,000 to $12,000. Basically, that would cover wages for the full 12-week period if you've got somebody that's out for the full extended 12 weeks due to a child being out of school and out of daycare. And then the most important one based on this presentation is they're proposing to extend the employee retention credit through the end of 2021. That is in the bill that is expected to be voted on tomorrow. With that, we are exactly at 10 o'clock, and if there are other questions, I can certainly hang out and address those, but I wanted to make sure we were timely and get everybody on their way if they so choose.
All right. Okay. So I have a little stack of questions here. So if anyone, and of course, just a reminder, this session is being recorded, and you are also welcome to, again, send these questions If you don't have time to stick around, that was Nick's information there. So if you wanted to send it directly to him, or any questions to us, we can make sure that Nick gets them. That's support@centerstateceo.com. But there is Nick's information. So I'll just, let's see here. So if you would qualify for the ERC from January 1st, 2021, but then receive PPP2 February 5th, 2021, would you be able to receive the ERC for 1 month?
Yep, those wages that are not forgiven under the PPP program would be eligible for the ERC.
Okay. And where can you find the detail of additional costs eligible for forgiveness?
We've got information on our website that would direct you to that information.
Okay, perfect. And is the forgiveness the same for the second draw, or is that to be determined?
Forgiveness is going to work the same. So I would imagine that the forms that are being used now are going to be used with the second round of forgiveness applications when we get to that point, probably in the summer timeframe.
Okay. And is the PPP program second round currently available only to small businesses with less than 20 employees?
Yeah, so there was, I know that the president had wanted to make that eligible only for a 2-week period, I believe. I'm not sure if there was anything that he released that made that, a rule or made that a requirement. But I know that there was some talk that he wanted to make it eligible for those smaller employers for a 2-week period of time.
Okay. Great. Any other questions popping through? All right. Yep, one just came through. So if our revenue decline is greater than 50% in Q2 2020 compared to the same quarter in 2019, but we used PPP funds for all payroll in that quarter, we don't qualify for the ERTC in that quarter?
Correct. If the wages, if you needed all of those wages to achieve full forgiveness, then the PPP comes first, and you cannot use those same wages for the ERC.
All right, going once, going twice. Thank you so much, Nick, for sticking around a little bit. Again, any further questions? If I missed any, I'm so sorry. And if you have further questions, please email Nick, or again, you're welcome to email support@centerstateceo.com. That is another way that we can help you reach Nick if you don't have his information. These are other ways that you can stay connected with us. We do have COVID-19 resources available on our website as well. Our reopening toolkit, of course, events. We thank you for attending this event today. We have plenty of fantastic upcoming events for sales. We've got our sales training series, physical and mental wellness while working from home. Please look at our annual meeting, Center State CEO annual meeting. That's April 29th. Save that date. And tonight, we do have a business after hours with a virtual twist. That's with the Syracuse Crunch, and that's at 4:30. And we would love to invite you for attending a complimentary pass for tonight. So look for that email coming with your survey. Thank you all so very much. Thank you for sticking around. Thank you, Nick. Really appreciate it. And with that, I think we will be signing off. Have a great day, everyone.
Great. Thank you, Jess.